Hope you're having a great conference out there. Before we talk about Asia, I just want to set the context for the world as well. A lot of data points coming in out of the US. Now, fewer number of people are believing or expecting many rate hikes this year, but now the can has been kicked for 25. What are your thoughts on the health of the US economy right now? The street may want actual rate cuts, but the real world wants growth not to stall big time in US. How are indicators looking in your view?
So we are very constructive on the U.S. Economic outlook. There are two things that are going well for the U.S. Number one is that there has been a strong capex cycle that is underway. To give you an example of that data point, U.S. non-residential capex is currently growing at about 5.2% real. And that is extremely strong considering that overall real GDP growth is somewhere around 2.5% to 3% on a year-on-year basis. And number two is that there has been a big pickup in the immigration inflows, and that's providing the support to the labor market. There has been a positive labor supply shock. So from a Fed's policy decision-making perspective, you've got a bigger economy in the U.S., but not necessarily tighter economy. And so we think that the dynamic in the U.S. is evolving in a way that growth will continue to be healthy. And as far as the inflation outlook is concerned, because of this positive labor supply shock, we've seen a steady deceleration in wage growth. That we think will eventually bring down inflation to a level where Fed can begin cutting interest rates. And more specifically on that inflation outlook and the Fed policy outlook, we are expecting that the next 3 months inflation prints will be 0.2% month on month, i.e. annualized rate of 2.4%. And that would give the Fed the comfort to cut interest rates from the September policy meeting itself.
That's interesting to note. Let's shift focus and come back to Asia. The second biggest engine right now in Asia and globally, of course, after US is China. And though the inflation numbers are coming lower, the concern on growth out there stalling in a very severe fashion. PMI data seem to be indicating that. What are your thoughts on the China growth and China inflation, because that will have a cascading effect on the entire commodity sphere as well, which the world and India consumes a lot?
Yeah, so I think the narrative that we have for China is that it's seeing cyclical stabilization, but the structural challenges are still persisting. Now, on a cyclical basis, there are two things that have helped China's growth situation. Number one is that there has been a pickup in global trade cycle, and that has helped improve everybody's exports in the region, but specifically China has also seen the benefit of that. And number two is that they have actually pushed in more investment in the manufacturing sector. So they're trying to manage and support that real GDP growth with increased investment in the manufacturing sector. So that's helped them to keep GDP growth in the range of 4.5% to 5% on a real basis. But the challenge we feel is that the structural issue of slowdown in demand because of property sector is still exerting deflationary pressures. And in that environment, as they are trying to support real growth with more manufacturing investments, it's resulting into excess capacities and continuing to have that inflation in a weaker trajectory. So, yeah, I think from a structural perspective, the issue that we were most concerned about is this debt deflation loop risks. Those risks are still pretty much alive in China.
Right. Chetan, let's come back to India. I remember in our previous interaction, you had indicated that India and Indonesia could actually start or kickstart the rate cutting cycle in India whenever it happens. Why don't you revisit that to us and the way data points have kind of come out between our last two interactions? How does it appear from here on?
So we have a few weeks back taken out our rate cut expectations for India. And the basis for that is that we think that credit growth is running at a pretty healthy and strong run rate. At that rate of credit growth, the leverage pickup in the system is quite meaningful. So it will be difficult for RBI to encourage further acceleration of credit growth by cutting interest rates. At the same time, the deposit growth is much lower compared to credit growth. And as you saw in the last monetary policy, the RBI had kind of given a soft guidance to the banks that they need to kind of try and fix and bridge the gap between credit growth and deposit growth. So again, in that context, if they cut interest rates, it will encourage banks to cut deposit rates, which will take them further away from that bridging of gap between credit growth and deposit growth. And then the other aspect that we were thinking about is the trajectory of inflation. So to the extent to which we think inflation will go down to 4.5%, but not necessarily 4% and sustainably stay there, it will also be difficult for RBI to cut interest rates because of that reason.
Chetan, but we have just started monsoon here in India. If it indeed comes out as a normal monsoon, the full season, do you see that will also have calming effect in parts of the inflation and hence things could be under control?
It should definitely help the food inflation outlook, and food inflation, as you know, has been the key reason why inflation is above 4% for the central bank. So it will help. Having said that, the challenge for food inflation is that we could get volatility in one or the other segment. Right now it's onion prices and then some other segment. So I think to the extent to which volatility in food inflation has been persistent for a number of years, it is difficult for us to build food inflation going down meaningfully, like going down to 4% and staying there for a longer period.
If you like this video, then like, share and subscribe to ET Now.